Adobe just reported record results, and the market sold the stock. That is not a glitch. That is a verdict. When a company prints its best numbers in history and institutional investors still hit the exit, something structural is being priced in that the earnings report cannot explain. And then the CFO walked out the door, headed for a chip company. Today, we are going to decode exactly what the market is telling you here, why the CFO move is arguably the more important data point, and how a separate story about AI, token prices, crashing, ties all of it together into one coherent picture. Let's start with the paradox, because it is only a paradox if you are reading the wrong variable. Adobe reported record results. By any backward-looking measure, the business performed. Revenue up, margins presumably intact, the machine is running, and the stock slid. Financial media frames this as a mystery. It is not a mystery. It is a valuation reset happening in real time. Here's the framework you need. Stock prices are not a report card on what a company did. They are a discounting mechanism for what the market believes the company will do over the next 3 to 5 years. When a stock sells off on record earnings, the market is not saying the past was bad. It is saying the future looks smaller than the price implied. For Adobe specifically, the analytical question is this: what is the credible growth vector from here? The company built its moat on creative software subscriptions. Photoshop, Premiere, Illustrator, the entire Creative Cloud ecosystem. That moat was defensible for over a decade because the switching costs were real and the skill barrier was high. Then generative AI arrived and began compressing both. You do not need Photoshop to generate a product image anymore. You need a prompt and an API call. This does not mean Adobe is collapsing. It means the market is recalibrating the size of the addressable moat going forward. Record results in 2026 can coexist with a declining stock if the forward earnings multiple is being compressed. That compression is the signal. Investors are saying, "We believe you. We just think the runway is shorter than the price assumed." The actionable insight here is simple. When evaluating any software company in 2026, do not anchor on historical earnings growth. Ask what percentage of that revenue stream is defensible against a $0.002 per token AI alternative. Now let's talk about the CFO departure, because this is the data point that mainstream financial coverage is almost certainly underweighting. The CFO of Adobe is leaving for a semiconductor company. Take a moment with that sentence. CFOs are not impulsive people. They are, by professional design, the most risk-calibrated individuals in any executive suite. Their job is to know where the money actually flows before it shows up in quarterly reports. They sit inside the capital allocation decisions, the revenue forecasting conversations, the partnership discussions that never become press releases. When a CFO at a major software firm voluntarily moves to a chip company, they are making a career bet with their reputation and their time. The two things senior executives guard most aggressively. What does that bet communicate? It communicates a belief that the hardware layer of the AI economy, the silicon, the inference chips, the memory bandwidth, has a more durable earnings trajectory right now than the software application layer. That is a sophisticated read, and it aligns precisely with what we are seeing in the broader market. The infrastructure side of AI continues to attract capital, while the application layer faces the question of commoditization. This is not speculation about one person's career choice. This is a data point and a pattern. Smart, well-informed, senior executives are migrating toward hardware and infrastructure. They have informational advantages that retail investors do not. You are not required to follow them blindly. This is not financial advice, but you are leaving signal on the table if you ignore the direction of movement entirely. The actionable insight: track executive movements between sectors as a secondary indicator. Career capital flows before financial capital, and the semiconductor sector is currently attracting both. Now we connect the third headline, and this is where the full picture comes into focus. Separate reporting this week indicates that AI token prices are about to plummet. If you are not tracking token pricing as an economic variable, start now because it's the underlying force that explains both stories we just discussed. Here is the mechanism. AI models charge per token, roughly speaking, per unit of text or data processed. As model efficiency improves and competition between providers intensifies, the cost per token drops. That is deflationary pressure on the AI services market. For end users and developers, cheaper tokens are an unambiguous win. For companies whose business models are built on charging a premium for AI-augmented software, it is a structural threat to margin. Adobe's exposure here is direct. The company has been integrating generative AI into its product suite through Firefly and related tools. That integration was a reasonable strategic response. But if the underlying AI capabilities become dramatically cheaper through token price deflation, the premium Adobe charges for AI-powered features faces downward pressure. The value add of the wrapper shrinks as the cost of the underlying capability approaches zero. This is the same dynamic that played out in cloud computing. Early cloud services commanded significant margin. Over time, compute costs deflated, competition intensified, and the margin migrated toward differentiated services built on top of the infrastructure. We are watching the same cycle begin in AI. The application layer gets compressed, the infrastructure layer, chips, data centers, interconnects, retains pricing power because supply is physically constrained. ChatGPT reaching 1 billion monthly users while public AI sentiment sours is the final piece. Adoption is not slowing. Perception is complicated. That divergence matters because it tells you the technology is embedding itself into behavior even as cultural skepticism rises. The demand for AI inference is going up. The price per unit of that inference is going down. The companies that own the infrastructure, that runs all of it, sit in a structurally advantaged position. Connect that back to why a CFO just left a software company for a chip firm, and the picture resolves completely. We opened with a paradox: record results, falling stock. By now that paradox is resolved. The market is not confused about Adobe's past. It is pricing a more constrained future in a world where AI token costs are collapsing, and the people who know the numbers best are quietly moving towards silicon. The follow-up question, worth sitting with: which software companies have moats that survive token price deflation, and which ones are one API away from disruption? We are covering that next. Subscribe so you do not miss it.